All right, guys. I hope that you are doing well everywhere that you are, and welcome to my channel. And today we are discussing a very important topic, and that is on the candlestick patterns. And today I have a pleasure of presenting to you 5 powerful candlestick patterns that will be a game changer to your trading journey. So forget about the other 100 or even 1,000 candlesticks that are always explained and exaggerated there on YouTube, and just focus on these powerful patterns. I'll be explaining how to use them, where to use them, how to identify them, and how to enter a trend based on this candlestick. As you are aware, when we are talking about the price action, generally what we are trying to understand is what the candlesticks are telling us. So keep hooked as you learn more. All right then. Let's look at what is a candlestick chart, and we are seeing a candlestick chart reviews the stock opening, closing, high, and low price. It's a powerful sentiment indicator that shows the bullish or the bearish bias in the short term. So, we have two different types of the candles. We have the bullish and the bearish candlestick, and we want to start with a bullish candle. A bullish candle is always a green or sometimes white in color, and you can always change this one. It has an opening price and the closing price and the range. Let's say, for example, the opening price was at 10 and the closing price was at $12. So the difference is uh 10 minus 12 minus 10, which gives you a profit of $2, and this is called the body of the candle. That means the price moved from $10 and went all the way to $12. So if you bought this instrument, it means that you made $2. So sometimes you find that the price can go all the way up to 15 and then comes down to 12, or then it can start from all the way from 10 and goes all the way to 9 and goes up again to 10 and goes up. So the 15 value is the highest price that that market went, and the $9 is the lowest for that day. That forms the overall range of the candle. So the vice versa is always true for the bearish, and the bearish pattern is always red or black. And again, we are saying that this one you can always change depending on what feels more comfortable to you. But now for the bearish, you'll find that the opening price maybe was at $10, and then the market maybe went all the way down to a different figure, and let's say it went all down to around 9 or 8, and then the difference is like negative $2. If you sold, you make $2, and if you and bought this one, it went against you and you lost that amount. So sometimes the value can go, market opens and then goes high to maybe $11, and then before the trending again to $7 and a little bit going up again to the closing price, and that is all what we call the range. So this is what fundamentally you really have to understand about the candles. So as simple as it is, but it's very powerful. Without you being to interpret this one, then you already lost even before you've begun your trading journey. So you have to read it, and then from there it will be as easy as ABCD. All right. All right, guys, and without wasting much time, let's discuss our first powerful candlestick pattern, and that is a bullish pin bar. So in a bullish pin bar, what you have to understand is it is a candlestick which has a very small end and sometimes no end at all, and have a very long shadow or a wick. So actually the wick can form at least 2 thirds of the total candle. So again, I want to emphasize here, before you take a trend using the candlestick pattern, then you have to identify the trend. All right, like we have always been saying, is that the trend is your friend. So for you to take a trend, you identify your trend. So for the bullish pin bar to make sense, it must happen in an uptrend. Okay, and how do you know that the trend is going up? It has to be forming a higher highs and a higher lows. And another easiest way to identify this one is when you have to use a moving average trending system, where you plot 200 moving average, 150 moving average, and 100 moving average and 50 moving average, and they are all sloping upwards. That means that the trend is going to an uptrend, as you can see here. So when the candlestick bullish pin bar appears in such a setup, then it's a strong indication that this trend is almost continuing its upward momentum, and you can be ready to enter on the confirmation candle. So as you can see in this chart, we have this bullish pin bar, and then immediately the price rejected one of the moving average. The following day, we end a confirmation candle, and boom, it went up. All right, here is another one, a bullish pin bar, a confirmation pin bar, and boom, moving upward. In a different video, I will be talking about a different strategy, about the bounce back strategy, which again is a combination of moving average and this powerful candlestick pattern that we are using. All right, I hope that one is clear, and you can easily make a whole trading condition using this setup. All right, very good. And now we want to discuss about the second powerful candlestick pattern, and that is bearish pin bar. And if you have understood the bullish pin bar, the bearish pin bar is opposite. We have a small body pointing downwards, and we have a very long shadow or a wick pointing upwards, which definitely looks like an inverted shooting star, and also forming more than 2 thirds of the total candle. Again, as I have explained this one, remember it has to happen in the right form of the moving average: 200, 150, 150, or sloping downwards. That is the only time that you can say that this is a valid condition, like you see here. So when the moving average are all sloping downwards, then it's a clear downtrend. So bearish pin bar forms at one of the moving average as shown, and you get positioned to enter this trend and to short your trend. And the moment it happened, boom, here we went down. All right, as you can see, a bearish pin bar, moving average on 150, and then confirmation, and boom, up, down, and it's one of the profitable trend. Um, so generally, this how it happens. One condition number one, identify the trend. Secondly, identify the candlestick pattern, and then you enter the trend. All right, guys, and now we discuss the third power of candlestick pattern, and we are talking about the tweezer bottoms and the tweezer tops. So when we talk about the tweezer bottoms, we are talking it's bullish. Okay, it's bullish. So it happens when the price is going or trending upward. So how does it happen? How do you know this? Remember our system of the moving average: 200, 150, 150, and 20. They are all aligned and pointing upwards. Then the prices on retracement, coming to one of the moving average, and when it hit our support triangle, one moving average, it forms one bearish, followed by another bullish green candle, which is equal to the size of the previous bearish candle, all right? Like we used to say in school, +1 minus 1 is equal to 0. So it zeroes out and give us an indication that this one is rejecting the support line and it want to bounce off again that moving average, all right? And the combination of the two forms like a pin bar. I told you like a pin bar is the progeny of all the candles. So we have one bearish, let me draw this one. We have one bearish candle. Sorry, let me do it in a different color. Let me do it in red. Oh, sorry. Okay, this is my red bearish candle, which is coming towards the support line. And then immediately this one, we formed another green bullish candle, which is the same size as this one. When we combine these two, all we form is one pin bar. Okay, the mathematics of this, we have the red bearish candle. Okay, it end an opening price and the closing price. That is the opening price, and then we have its closing price just here, and which is again at the same size with the bullish green candle. Okay, so both the opening price and the closing price of the bearish candle and the closing price and the opening price of the bearish candle is the same. So when we represent this pictorial form, boom, we form a pin bar. All right, that's as easy as it gets, right? I hope you understand that one. Great. Okay, so next we want to discuss the reverse of the same, which is the tweezer bottom. And for the tweezer tops. For the tweezer tops, it's a bearish. It happens on a downtrend. Remember, now our moving averages will be sloping downwards, and then we have a correction of a small bounce of a bullish move. And then when it hits one of our resistance line, which is the moving average, we form another a bearish a candle, which is equal the size of the previous bullish candle. Again, like we say in the other one, we end a bullish candle, which has a opening price and the closing price. And if we combined these two, we form a long bearish pin bar. Okay, so opening and closing price, we form a bearish pin bar, and boom, that one tells us now the price is about to reverse. But again, remember, before you enter that trend, you will have to wait the confirmation. Now let's give an example here with our chart. Can you see our tweezer bottom here? This is an uptrend, right? If you saw it, this is our tweezer. The prices were coming, the overall trend is uptrend, as shown by our moving averages or sloping upwards. And then at some point, because the price end to breathe in and out, started breathing out from the top, and then it came all the way down, and in these second ones, it forms a tweezer bottom. So that is a bullish. These are the tweezer bottoms that I'm talking about. They came all the way to 200 moving average, and then when this bearish candle closed below the 200 moving average, sorry, we formed another bullish candle, which is green, and then we end a confirmation there, and boom, the price went up. Okay, this is what I'm saying. It's easy as it gets. If you remember the top, the pin bar then you don't have a problem with this one. All right. Next on our list, we have one white soldier and one black crow candlestick pattern. And the one white soldier is always considered a bullish setup. And generally, one white soldier is a bullish candle that opens above the close of the previous day's bearish candle and closes above the open of the previous day's bearish candle. Okay, you have to read that again. We are saying that a bullish candle that opens above, a bullish candle that opens above the close of the previous day's bearish candle. Okay, this is it. And also it closes above the open of the previous day bearish candle. So we have the bearish candle and it's red. I write B for bearish. And then we have the green one, which is opening above the close of the previous bearish candle. Like it just opens up with a gap. That was the opening. And here is the closing of the previous day candle. And this one now, the following day, if you're looking at 1 day chart, it opens above the close of the previous bearish candle. You see, closes above the open of the bearish candle. Sorry for that. And this is the close. So you see that it opens above the close of the previous and closes above the open of the previous bearish candle, and that forms as a confirmation that the price is rejecting the previous support, and then it is then looking to go upwards. This is a very strong candlestick. If you don't get it, please, you can play back the video so slowly so that you can understand this one. It's again a very powerful candlestick. And if you look at it, it's like the candles are forming the higher lows. You see, it's like forming higher low, and then you have to contextualize the same. You see, it's an uptrend. The prices are breathing out. They ate the support line or one of the moving average, and then boom, it goes up. Right. So now to one black crow, which forms on uh, a downtrend. We have our moving averages, which are trading downwards, and then the price moves down, and we are seeing a bearish candle that opens below the close of the previous day's a bullish candle. Right, see it? We have the bearish candle. This is the bearish candle, which, and we end the previous green candle, which is a bullish candle. All right, this is the bullish candle that we are talking about. And then we have now bearish candle that opens below. Okay, that's the opening and the close. This is the open of the bearish candle, close of the previous day bullish candle. This is the close, and then it opens below it, below the open. Sorry. Okay, and then and closes below the open. This where it opened uh, below the previous day bullish candle. You see, this was the opening, and then it just closed below it, and it's like it's forming um, higher low. You see that higher low and um, a lower low. Understand? So boom, one is the forms, then we get a signal that this price indication is almost reversing the direction. Okay, one, you have to understand where it is happening. We have a downtrend. This is the downtrend, and then it retraces back to one of the moving average, and then it moves down. Okay, let me give you the examples of both cases. Let's look for one white soldier. This is an upward momentum. We can see all the candles are going up, and all right, there we have one soldier. Okay, the previous we end a bearish candle which came to touch the one of the moving average, the 50 moving average. Then the following day we end another bullish candle which opened above the close of the previous candle, and then it closed above the open of the previous day. And once that happened, we ride on the trend and boom, we go to the moon. That's how you see it. All right. So one, you have to find first of all the trend. You identify this is one white soldier, and you wait for the confirmation. You don't enter the trend immediately. You want to wait for the confirmation, and then immediately there is a confirmation, then you can definitely take your trend. So here is another one. We end one soldier and bearish candle, and then we have a bullish one, and let's see if this one worked out or it went against us. What do you think? So we end one bearish candle. We have the bullish candle, which again closed above the open of the previous bearish candle, and it opened above the close of the previous bearish candle. So if you took the trend based on this signal, we should anticipate that it will go up like we seen in the previous case example. All right, so this is how you just look at it. You don't have to struggle to stand the other candlesticks. Okay, you just have to wait for it, and then you wait for the confirmation, and if the confirmation is activated, you take. Okay, let's go to one black crow. One condition we said again, it must be on a downtrend, and this is our downtrend. We see all the moving averages are sliding downwards, the 200, the 150, the 50, and the 20. And right there, we have our one black claw. Previous, we had one bullish candle, and then we have one bearish candle, which is opening below the close of the previous bearish, and it closes below the open of the previous bearish candle. Okay, so we say one black claw, it will always appear at the resistance of an uptrend, and this is the secret, guys. If you take a good trend with a good risk reward ratio, you have to take it closer to the support line, so that your risk is really small, and it guarantees you a bigger risk reward. So here it is, we end our bullish candle, and then we end our bearish candle opening again as condition we have mentioned, and the prices went down and down. Always have a checklist on this. This is another example. It gapped down. You see, that was our candle, and then we end our black claw down there, which actually it's a huge gap, and the audit maintained the prices and are closed below the open of the previous bullish candle. That is the bullish candle, and this is where you could have taken your trend, so that you could have gotten a good risk reward ratio. All right, guys. Okay, all right. Let us quickly go to the next powerful candlestick pattern, and we will be discussing about the morning star and the evening star. So the two depends on the trend. So the morning star is considered to be a bullish candlestick formation, which forms generally on an uptrend, whereas the evening star is on the downtrend or the bearish momentum. So for both of them to make sense, they must have 3 candles. Okay, so let's start with the morning star. So in the morning star, the first condition is that we have an uptrend. Okay, and we say the only way that you can know that the direction of the trend is uptrend is looking at the moving averages of the year round. That is 200, 150, 150, and 20. They are all sloping upwards. And then once the prices are rising up, they also have to sometimes breathe out. Okay, so they start coming down towards these moving averages, and at one of the moving average, it will act as a support level. Okay, so we have the bearish candle number 1, which is coming down, and it is almost close to our support or the moving average. And then the next day candle, it opens up with a small gap. Okay, and it's really small. So let's say our bearish closed at $5, and then the following day the small candle opened at a $4. So there is a difference of $1, and that means that we end a gap. Okay, now this gap is this gap candle is around the support line or the moving average. Okay, now we go to the third day, and on the third day the prices opens way above um the close of the previous doji or the small candle. Okay, let's say the price closed at $3, but now it opens up at around 5.5. So we have a gap of around $2.5, and then it closes again above all bullish or green in color. Okay, so that complete our pattern. So the new candle number 3, it has to close more than 50% of our bearish candle. Okay, so we have candle number 1, candle number 2, and our candle number 3, and we have the gaps. Okay, and that way we get the signal that now the prices are reversing, or the upward movement is going up. Okay, all right, so I can just read it for you. Like 1, we have long bearish candle number 1, 2, a gap down to a small candle, and then 3, gap up to a bullish candle that close above half the body of the bearish candlestick. All right, guys, I hope that one now is clear. Okay, so next we go to evening star, which forms on a down one move. Don't worry, I'll give you the examples in a chart in a few. So but for now, the evening star of the bearish, the price must be going down once, or all the moving average should be sloping down, and then the prices start to correct upwards, and our candle number 1 now will be a green bullish candle. So, and then our second candlestick, which is very small, or like a doji, opens up, or it caps up, or it opens above the close of the bullish candle. All right, and close to our resistance line, which again is one of the key moving averages. Okay, then candle number 3 opens below the close of this small candle. All right, that will be the candle number 3. So we'll be having that gap. So that one point out that the downtrend is continuing. All right, so our condition is we have the long bullish candle, 2, a gap up to the small candle, and then we have our 3, gap down to a bearish candle that close below a half of the candle, which is bullish candle. Okay, so I hope that one is clear, but you have to understand all these criteria. 1, you have to understand the direction of the trend. That is very important. So you have to put all your moving average and don't get emotional. Or if you don't see a clear setup, just skip it. Okay, don't risk. All right. So you wait patiently, and I always recommend that you point to the daily chart. Okay, and now here is an example, okay, of a morning star, which is a bullish reversal. Okay, we have our moving averages. Again, condition number one, they are all sloping upwards, and this certify the condition that we're in a bullish market. Then we have a small correction move. You see, after high trend, we get closer to a moving average. The prices reaches the 50 moving average with a bearish candle. The next day, a small doji, a small candle opens with a smaller gap below that previous close of the candle or the bearish candle. All right, that is day two. Then you wait for day three. We have a bullish candle which is gapping up from the previous small candle or the doji candle. All right, and this now it fulfills our whole criteria that now this is a morning star, and you can actually put your buy. So this is an extra for you and a bonus for you, how we use the morning star and evening star to anticipate the reversal on oversold and overbought conditions. So for Morningstar, we use a Bollinger Band, I mean is the moving averages again, and also we use the stochastic stochastic oscillator. So the prices this now is trading downwards, and the prices hit the bottom of the Bollinger Band, and at the bottom of the Bollinger Band it forms the morning star. All right, so at that point the stochastic is oversold, and then we have our morning star which forms at the bottom of the Bollinger Band. So that one we can start placing our buy orders. Okay, okay, a short buy orders, and put our take profit maybe at the top of the Bollinger Band. So the condition for this one is easy. From the morning star, the prices are trending downwards. It pierces through the Bollinger Band, okay, and at the bottom of that Bollinger Band, it forms the morning star. Okay, then you buy. Okay. Then how do we use the evening star? The prices are going up, okay, and then it pierces the top of the Bollinger Band again, and at the top of the Bollinger Band we form the evening star. Okay, we have the candle number one, it opens up and gap, and then we have another bearish candle at the top, and then boom, we anticipate the reversal. Okay, you put a stop loss at the top of that doji, okay, or at the top of the Bollinger Band, and then you put take profit below the Bollinger Band, which is at least the two. Okay, remember this one is purely counter trending. That is if you are going risk taker, so you are not staying there, you are just buying for a very short time and then exiting the trend again. This one is for a more advanced trader. All right, so both of them you have to use them in conjunction with Bollinger Band, the moving averages, and the stochastic oscillator. All right, okay, so we go to the third one, that is the engulfing candle patterns. That is the bullish engulfing and the bearish engulfing. So the bullish engulfing, it's for the uptrend, and again remember we said the prices are going up and it's now breathing out towards the moving averages. So at the close of the moving average we form a bearish candle or a small bearish candle, and then the next day it is followed by a large bullish candle with a body that engulfs, okay, or wraps up, okay, the bearish the candle. It means now that the buyers are so strong and the prices won't to move up. Okay, so again, the engulfing candle must be covering the whole range of the previous bearish candle. Okay, all right. So again, remember about the trend. If it is the bullish engulfing, the trend must be going upwards. Okay, and this would be just be a small correction move, which comes closer to the support line or the moving average, forming a small bullish candle. And then we have a larger candle with a bigger body that engulfs or covers the whole of the smaller candle. Okay, so that is what is called the bullish engulfing candle pattern, and we shall be seeing this one in the real example from the chart that I will try to pull through so that we can also see. So for the bearish engulfing candle is the opposite of the other one, and it forms on a downtrend. All the moving averages are sloping downwards, and then after maybe a bearish move, there is a small move upwards. Okay, a retracement towards the resistance level, which is a moving average. And then we have a small bullish candle, and then we have a very large bearish candle that engulfs or covers the small bullish candle. Okay, this tells us now the sellers are rejecting that prices and they want to push the prices down. Okay, let's look at some examples. So let's start with the bullish engulfing at the support on the trend line. Okay, these are moving averages 200, 150, 150, and 20. They are all sloping upwards, telling us that we are going up. All right, can you see this engulfing candle? Yes, it is there. So the prices were coming down and down and down, and then at one of the moving average, that is 100 moving average, we end a very large bullish candle that engulfed or covered the O of the previous small bearish candle. All right, and this one was a clear indicator that we are going upwards. Right, so you put a stop loss just below that engulfing candle or below the support, then you move. Here is another example. Can you see it all? We have a small bearish candle and we have an engulfing candle, and it is happening on 50 moving average. Okay, again you put the stop loss and boom, there you get it. Right, so we can see all these small examples over and over about the engulfing, bullish engulfing. All right, so you can pull your own chart and check if you can see any engulfing candle, and see if you can get it. You can pull any of your stock charts and try to study it closely. All right. Rate when to use candlesticks. So as I've been saying that the candlesticks can only work when you use it in the correct context. So it is important that candlestick patterns must always be analyzed in the context of the price trend. Okay, you have to know which is the direction of the trend. So we only go long when a bullish candlestick pattern appears on a at the support of an uptrend. Okay, support of an uptrend, and remember it goes with wave up, wave down, wave up, and wave down, and then it happens. For example, here we have the pin bar forming maybe at the point of the support, and our trend line we use is always the moving average. If it is going up, then we look for the pattern at that support. All right, so that is the correct context. Or at the bottom of a downtrend, okay, when extreme oversold conditions are met, that is counter trending. And as I've explained, the counter trending where we have been using the Bollinger Band to and the stochastic oscillator to tell us if the market is oversold. Okay, and then you check at the formation of that candle, and then you just counter trend, which is a little bit risky, but again can be doable at those advanced levels. Okay, so most important and very important, you have to put the candlestick at their correct context. Two, you must understand the trend, and I won't emphasize this enough again, because this is where people go wrong. You find a candlestick pattern or a bullish candlestick pattern, but it is happening on the downtrend, and you do it, and then you go into a loss. Okay, so uh, the second scenario is we only short when the bearish candlestick pattern appears at the resistance of a downtrend, okay, or at the top of an uptrend when extreme overbought conditions are met. Okay, so it's a similar level. The prices are trending down and the moving averages are sloping down, and this I'm giving an example of a pin bar, and then a pin bar forms at that one of the key moving average, and then the prices continues downwards. All right, okay, so that is it. And part B, at the top of an uptrend when extreme overbought conditions are met. Okay, that is counter trending. So you use the Bollinger Band to tell you overbought conditions. You see one of a candlestick pattern forming there that have explained, maybe a pin bar or a gaffing or the morning star. Okay, the one white or okay, or the crow, you see it there, and then you short the market. But for counter trending, again, I will emphasize that a market can be overbought or oversold for a very, very long time. So if you have to counter trend, you have to counter trend this one with a lot of cautions and with very tight stop losses. Okay, and with already predetermined exit or take profit level. And with that, I come to the end of this webinar, and may the market be with you. And don't forget to like and subscribe, and put that notification bell on as we meet for the next episode on trending psychology. Okay.